entities and state-backed corporations to transition to domestic hardware for personal computer. But next week we have the Apple event on the 12th. We remind ourselves that not just the proportion of revenue that comes from Greater China, but so much of the installed device base is there. So it's a worrying time for them. It will be interesting to see if they actually proactively address this next week.
Ed, thank you very much indeed. Bloomberg's Ed Ludlow. You can catch Ed, of course, and Caroline Hyde on Bloomberg Technology coming up in around 90 minutes' time. They're going to have more on that interview with Ripple Executive Chairman Chris Larsen. Coming up, we need to talk about that data that we got out of the ISM. Absolutely fascinating on the hiring front. Bruce Van Saun is going to join us from Citizens. He's the CEO.
We're about an hour into a trading session. Let's see if you heard this one before, right? Good news, bad news for the equity market. ISM services kind of blowing out of the water, and equities heavier on that report. Abigail's tracking the moves. Abby?
Indeed, Alex. We have the S&P 500 down 0.7%. The worst day in about 2 weeks. In fact, down a second day in a row. That is the longest losing streak in about 3 weeks. So this mini rally that we've had recently being disrupted, and by that ISM print largely that Alex was talking about, this idea that maybe the Fed's going to have to step step in. It might not be in September, it might be at the November meeting, but nonetheless, this idea that more money might be taken out of the system. We see this with the Bloomberg Dollar Index up 0.2%. Yields are higher, pressuring stocks. The NASDAQ is down more. Over the last 2 days, the S&P 500 down more than 1%. Let's connect this. This chart is pretty busy. We've taken a look at it before, but it's a helpful chart. What we're looking at here in white is the S&P 500. In blue, we're looking at the Bloomberg Dollar Index. You can see a clear inverse relationship. So as the S&P 500 has gone up this year, the dollar was basically in a range, but now the dollar is starting to break out. The Bloomberg Dollar Index is still in this range. It looks to me like we might actually see the S&P 500 go out of that range if the dollar continues to climb. I would say that there's a pretty strong chance of that, especially since the S&P 500 right now in overbought territory. That's actually bullish, but if it starts to turn back down, as it may, beware for sure. Another pressure right now, and this is so interesting, we actually have oil higher, not so much on the day, but over the last couple of months, we have oil up 22% on the year, up more than 10%. And right now, into today, despite the recent dollar strength, you have this oil rally. You usually don't see that. Is there really the demand out there? That ISM print may suggest it. It's interesting, though, rising oil, Alex, as you know, not so great for airlines. And of course, 3 of the big airlines today came out saying that rising oil might produce a problem, but you can see Southwest Airlines is the one that's really suffering, down 2.2%. They tightened their revenue range. They're also talking about August was a little bit weak for consumer discretionary spending, but they see more strength. But I think we have to discount Southwest Airlines, Alex, because of course they had the snafu last December, so it's probably not as even of a look. And the airline group overall higher.
Yeah, but no doubt that word hedging is going to come back into play. Abigail, thank you very much. Really appreciate it. All right, well, activity in the U.S. services sector just crushed it in August, driven by strength in new orders. You also got hiring. The demand's really there. So we want to take a broader look at the consumer and the overall economy with Bruce Franson, Citizens Financial Group CEO. He joins us here on set. Bruce, great to see you. Thank you for joining.
My pleasure.
So the ISM services gives one picture. The excess savings, potentially people spending on credit cards, student loan debt coming due, that paints another picture. What picture do you have?
I think the economy remains in pretty good shape, and we're likely to see the soft landing scenario, I think, now has moved to the fore. So I think the Fed has done a good job of bringing inflation lower, but not completely snuffing out the job market, so people can still find jobs. They've exhausted some of their excess savings, so as you say, they're starting to draw down on some of the savings that built up during the pandemic, and then also starting to borrow on cards a bit. But for the most part, consumers are in good shape. We're not seeing any loan delinquencies, and companies mostly are in pretty good shape as well.
Bruce, good morning. It's Guy. Do you think, therefore, the Fed has done enough? Do you think it needs to do any more to slow the economy down?
Yeah, I think they likely have done enough, although we'll just have to watch it. I think the ticking up in energy prices is something to consider, the continued strong consumer spend. But, you know, monetary policy works with a bit of a lag, so I think they have to wait through November and take another gauge of the data at that point. Likely they're done. If they go again, it might be one more 25 basis point hike. But I think that's it. And then likely we would see a pretty long period of stable rates before you start to see cuts. I think those likely hold off till the middle of 2024.
Just one more quick one on the consumer from that end. You guys did wind up ending your car dealer financing, right?
That's correct.
And it was because of recession worries. Like, are you disappointed that you did that now because of where the economy is? Or are there other areas that you're looking at?
It's a little more nuanced than that. So effectively, once deposit costs increased through this whole rising rate with the Fed scenario, and deposits became more dear, we kind of looked at where were we invested on the asset side of our balance sheet. And auto is a relatively short duration asset that we kind of used as a shock absorber. It's not a very strategic business because we don't have deep relationships with those customers. They're customers of the dealer. So this was more of a strategic play. Let's run down some of our higher cost funding and run down that portfolio. In its place, we're using the capital freed up to launched this former First Republic private bank that a bunch of folks came over to Citizens. And so we'll run down $9 billion of auto and related consumer paper and build up $9 billion of loans to the private bank's customers. And so therefore that'll become a strategic use of our balance sheet and replace something that wasn't that strategic.
Bruce, are you feeling a little over-regulated right now?
You know, we're in a heavily regulated...
Every CEO say yes, but you have to say yes?
Well, we're in a heavily regulated industry, and, you know, some of that regulation has really kept the industry strong and kept the confidence of all our stakeholders. I think at this point, some of the new proposals feel like they might be overcooked in terms of requiring more capital and kind of gold plating what the Basel framework intended. But there's a significant comment period right now that I think you'll get lots of views on that. So, you know, it'll play out down the road, but for the most part, we're continuing to try to maintain good relations with the regulators and keep the banking system safe and sound.
And of course, we're talking about having to issue longer-term debt if you have a market cap of over $100 billion. There also has been reports here at Bloomberg that the Fed is putting a lot of pressure on you guys, not you personally, but regional banks, to beef up other measures as well. How does that affect your end product?
Well, I think if you look at the report they did on SVB's failure, they had a bunch of MRAs, or these recommendations from the regulators, that really weren't followed up promptly. So you would expect in the wake of that the regulators are going to be more on the front foot, more putting pressure on banks to really tighten up how they run and to get things done on time if there's any issues outstanding. But I think that's all manageable, so I don't think it affects necessarily how we're running the bank, but we have the strength and the breadth of talent to be able to comply with what they're looking for.
Does more regulation, Bruce, imply more consolidation? Can I extrapolate one from the other?
Yeah, I think there's a couple things that potentially drive more consolidation. So that would be one. So if the costs of operating the bank on a standalone basis go up, and these new regulations really run right over tailoring, which there used to be break points where the load was a little less the smaller you got, which is now kind of called into question by these new proposals. So I think that could potentially foster more consolidation. The other thing is just the way the world is changing so fast, and banks have to invest in digital and data analytics and AI and cyber defenses and fraud defenses. The smaller banks really, to afford all of that investment, are going to need to consolidate, I think. So I think certainly at the smaller end of the equation, you'll see consolidation due to more technology and business model reasons. But the bigger banks, you know, the question is, do you want to have just 4 mega banks that are in the too big to fail category, or do you want to spread that out and have more competition for those very big banks? And that's a policy question that I don't think Washington has determined yet which way to go on that.
So does that mean no or yes to you? Like no or yes in terms of looking at acquisitions? Because you sit right in the middle of the two things.
Yeah, no, I think right now you're not going to see a whole lot of acquisitions, just because with rates as high as they are, the deal math doesn't work very well, and it's still very opaque in Washington as to what their posture is. So I think that'll kind of stymie deals over the next 6 to 12 months. But you'll start to see things getting done at the smaller end, and then we'll see if there's what happens with the next election cycle, and is there a change in the regime, and could that with falling rates, if rates go back down below 4% and there's a fresh regulatory view, does that facilitate more transactions maybe in 25?
How long do you think it's going to be, Bruce, before America has another SIP? Is that the ultimate direction of travel here? And do you see your bank playing a part in that process?
Yeah, we have a long way to go before we would get all the way to that size. But, I think some of the Category 3 banks, you've had PNC be aggressive as a consolidator. You've had U.S. Bank as well. So I think, there's opportunities for some to try to scale that $1 trillion level. We'll see how it plays out.
Give me some idea in terms of just the issues that were at play in this industry, say 6 months ago? Deposit outflows and deposit inflows. There were some concerns about other banks, etc.
Yeah.
Net income margins is getting squeezed. Has the bleeding stopped, or where is there still a trickle?
Yeah, I think we're in a period of stability. And from where I sit, the worst is behind us.
Okay.
And so deposit flows have stabilized. The migration from your non-interest-bearing deposits to interest-bearing has slowed. So I think you saw pretty good results on those dimensions in the second quarter earnings. I think that will continue in third quarter, that you should see more deposit stability. Certainly banks are going to continue to pay up for deposits, so funding costs are going to go up and margins are still getting squeezed a little bit. But I think they're close to bottoming out. The other thing that we're seeing is the capital markets are starting to open up. Like Citizens is going to be on the cover of 3 IPOs this month, which we haven't been able to say in a long time. And so there's deals flow starting to pick up, which also should help the revenue picture.
Great stuff. Bruce, thanks a lot. Great perspective. Bruce Franson, Citizens Financial Group CEO. Come back next time you're in New York as well. Coming up, we're going to take a look at how rising interest rates are putting pressure on hedge funds to perform. It's a basis trade. We're going to talk about it in today's Wall Street Beat. This is Bloomberg. Breaking news for you. WeWork is said to renegotiate nearly all of their leases and exit unfit locations. That stock was halted for trading volatility. It's now up 16%. I'm just going to go right to Wall Street Beat because Shonali's here and we're going to talk about it, and this is what the Wall Street's going to be buzzing about. Renegotiate all leases in some ways is not a surprise to me, but what are unfit locations?
There is no quantification of what unfit locations are. Now, this was a CEO letter posted on their website that starts actually talking about the hyper growth, the unsustainable growth that they had initially, and then it blames the pandemic. It says they navigated a pandemic and had gone through some of their transformation at that point. Now, remember, we knew that they are trying to operate now to avoid any potential future Chapter 11. They have cited going concern issues. They say that over 2/3 of operating expenses in the second quarter, they have been able to get a handle on it, but they still remain too high, and this is their wording, are dramatically out of step with the current market conditions. And so to the point we've been talking about in the commercial break while we saw this coming out, there are very drastic moves in commercial property prices, and now WeWork wants their share of the benefit of that.
Shonali, what's the next domino after WeWork?
That's a great question, because we know that WeWork is in a lot of these large commercial office properties in many cities around the world. The question, to your point that you were asking earlier, where exactly are the problems lying? A few more headlines around this is that they do intend to remain in the majority of buildings and markets. So this renegotiation process is pretty important, isn't it? Because it will determine whether they stay there or not. They will exit unfit locations, but again, we don't know exactly how many locations that will be, particularly when they're also saying that they want to stay in the majority of markets. So their total pullback, and remember, there were a lot of WeWork copycats as well. So the total market dynamic here is still unknown, especially when you see such a giant in the room going through such a massive transformation.
Before I let you go, there was also a really interesting article from the Financial Times that talked about basically hedge funds basis trades and how the Fed and regulators are quite worried about this. We even saw in Jackson Hole liquidity being a primary issue that they're focused on.
This is a massive story this year, and the reason being is you have a scoop we had earlier this year. The Federal Reserve, the SEC, has also been asking prime brokerages about it, and now an international body, the Financial Stability Board, really targeting non-bank investors and really blaming these investors for the spike in demand for the liquidity in March of 2020. Remember, this was largely a pandemic era. However, this was a moment the Fed had to step in and really intervene in repo markets, which are distorted in times of stress for these hedge funds. Now, they say macro and relative hedge fund strategies in particular, which tend to employ the so-called basis trades. This is the arbitrage between futures and current trading in treasury markets, which of course we know are very volatile. So everyone does have their eye on it. A lot of debate about how dangerous it is. Sometimes these trades are levered 50-to-1, guy, and clearly you have international bodies now taking a closer look as well.
It's interesting, even those in the market talk about the market being overfished. They talk about the inevitability of leverage caps coming in. Maybe that's ultimately the direction of travel here. Shonali, great stuff as ever. Thanks for being on hand to deal with that WeWork story. We'll come back to that in a minute. This is Bloomberg.
to highlight here, European natural gas prices are down sharply. The strike in Chevron's LNG facility in Australia is now on halt until Friday, so we get a little bit of a reprieve there. Speaking of energy, the Barclays CEO Energy and Power Conference is underway here in New York. The outlook for the industry very much in focus is oil around $90. Natural gas demand still picking up. So joining us now with perspective is Alan Armstrong, Williams CEO and President. Williams handles about 30% of the natural gas in the United States that's used every day to heat homes, cook food, and generate electricity. Alan, great to see you.
Great to see you, Alex. Thanks for having me today.
You bet. So what's your outlook? We talk about whether we're in a recession or not. Will we get there? Will we not? What's your outlook for the U.S. economy right now based on flows through your pipeline?
Yeah, you know, we are seeing a big pickup both in current demand. We've had 5 days this year over 50 BCF a day of power generation. So that's a 6% growth from last year's peak, which was also a big year for power generation demand. So we've actually hit a record this year of 53 BCF a day, which is an all-time record for power generation demand. And you might think of that, well, gosh, of course, because it's been so hot this summer, but this part of the country, as you know, barring this week, has not been all that hot. And really a lot of the populated part of the country really hasn't been that hot. So anyway, really extraordinary pull on natural gas coming from power generation right now. And importantly, a lot of signs of increases in capacity on our pipeline system. So I don't know when I've seen a time where we've had so much request for new capacity builds on our pipelines. And a lot of that, I think, is the market is realizing that reliability is going to have to be there. A lot of electrification going on around the country, and with that comes more and more pull on gas-fired generation to complement renewables in our markets.
Okay, so that's a big outlook. We've seen in the last 24 hours a lot of M&A now. Enbridge, for example, buying True Utilities from Dominion for almost $10 billion, right? Do you think that this demand and this shift that we're going to be seeing over the next couple of decades, are you buying stuff? What do you see for M&A in the sector?
Yeah, you know, I think for us, because we have so much growth, organic growth just around our existing asset base, and we've got such a large footprint that allows us to buy assets that are just bolt-on to our businesses, I think that's really the best place for us to play right now. So we continue to have very high return investment opportunities in and around both our gathering systems and our pipeline systems. And, you know, typically people think about pipelines being a regulated rate of return. And the truth is that on expansions, we're not limited by that because we can't be forced by the federal government or anybody else to expand our system. So it gives us, so in one way, the permitting woes of our country, which, you know, by the way, I think are really not good for our country. But on the other hand, being an incumbent pipeline has allowed us to continue to have really attractive returns in the expansion of our existing assets.
Alan, good morning. It's Guy. When you think about those acquisitions, you're thinking about the long term. How long do you think those pipelines are going to be carrying natural gas?
Yeah.
When you think about those acquisitions, are they going to be carrying hydrogen in the future? Can you just talk to me about how you see your business going through the energy transition and whether a pipeline is good for natural gas, is also good for hydrogen or other potential fuel sources?
Yeah, you know, here in the U.S. with low-cost natural gas supplies, hydrogen is going to have to be heavily subsidized for it to make work. We actually, as Williams, we have 4 projects in front of the DOE right now looking at hydrogen hubs, and so we are certainly a part of that. But the fact is natural gas is so much lower priced here in the U.S. and is such a lower carbon fuel that we think natural gas is going to be here for quite some time. We have a lot of room to run in terms of reducing higher carbon content fuels like coal and fuel oil. We've got a lot of ways to go to continue to reduce emissions by using that. You know, replacing coal-fired plants with gas is a 40 to 50% reduction. If we were to replace the remaining coal plants here in the U.S., there's about 230 remaining coal plants here in the U.S. If we were to replace those with gas, that's 35 million vehicles off the road.
Alan, you talk about the permitting issue. If the Republicans were to take the White House, do you think it would be easier to get permits for new pipelines in the United States?
It wasn't easy during the Trump administration. I always remind people of that, the permitting problem often starts at a local level, and really our permitting process is such a morass these days that it's not that simple just to fix it. Very thankful for the efforts of Senator Manchin in pushing for permitting reform and pushing for the Mountain Valley Pipeline, which is a huge positive for Williams. But frankly, I don't think it's as simple as just replacing administration. It's a very complex issue.
We just have about 30 seconds left. But if someone said, build all the pipelines you want now, Godspeed, go. Business booming. What's the biggest problem? Is it material? Is it labor? Is it cost? What is it?
It is dealing with the local right-of-way. So if you said, it's just so hard for me to get in my head that you could actually go build a pipeline without all of that. But I'd say building from the Marcellus and connecting the Marcellus to LNG export on the East Coast is the single biggest positive that we could gain for our country. Because we have this enormous resource, and the market is really hungry for natural gas around the world.
Okay, we'll get back to you on sort of what's the hardest part about that, aside from permitting. Alan, good to see you. Thanks for stopping in. Alan Armstrong Williams, CEO and President. Coming up, European close, Georgia Taylor of Invesco, Georgina Taylor will be joining us up next in the next half hour. This is Bloomberg.